to go? First, let me know. Is audio and video both okay? Are we good to go? Both okay? So let's start. Hello everyone. Good evening to all of you. Welcome to JAIIB CAIIB English Medium channel. So if you have seen yesterday's session, I guess you all are aware about this, that we have started our crash course for IFS. Yesterday we had an orientation class. Today we will be starting with the topic. Okay. And we will start discussing the topic of module C, because I will be taking care of module C and D. Kinshuk sir will take care of A and B module. Okay. So I will be talking about module C. First of all, module C overall covers your total units. That will be 9 units from unit number 20 to unit number 28. We have module C. Okay, and module C talks about Indian financial architecture, in which we have to study how the evolution of a financial system happened, what actually the financial system is, what are the different types of financial intermediaries are there which are helping us in the financial system. So first of all, very basic question I will ask from all of you: what is financial system? So you all are aware about financial system, right? So can you tell me what is financial system? Financial system. What is financial system? So simply, when we are talking about, like, we study economy or economics, similarly we study the financial system. And you all as a banker, you all are the part of the financial intermediaries under this financial system. Hana? So when we talk about financial system, what is financial system? It is simply a system where the exchange of funds will be done. It's a system where exchange of funds will be done among the person who have surplus money and with the person who have deficit of money. So financial system is simply a system where we are doing exchange of funds among the people who have surplus money and the people who have deficit of money. And this flow of fund will go from surplus money to deficit money. Okay, flow of fund will go from where? From surplus money to the deficit money. This is how the flow or the exchange of funds will be done under the financial system. So definitely you all are part of this financial system, because you are as a banker performing the exchange of funds on behalf of the people. Let's say if I want to transfer funds to my relative's account, to my friend's account, who is performing this need of mine? You all, as a banker, you are performing this fund transfer from one account to another account. That's what the financial system is. So like a bank, there are other intermediaries also who are performing the same work. Like NBFCs are there, microfinance institutions are there. They are also doing the same work. Their target is also same, to exchange fund among the person who have surplus money and the deficit money. And to perform this exchange of funds, this financial system requires some financial system component. Hana? So now we are going to discuss the components of financial system. So this exchange of fund will be done with the help of component of financial system. And this is the component we have. There are three components of financial system. The first, we have financial market. Financial market is simply the platform where we exchange the fund. Now, what is financial market? Financial market provides us the platform where the party who has surplus money and the party who have deficit of money, they both will come at the same platform and then will exchange their funds. So the first component is financial market. The second component is financial instrument. Financial instruments, which also covers your financial goods and services. Financial product or services, you can say. Then it means the instrument which we use to exchange the fund. And the third one is market participants. Third one is what? Third one is a market participants. These are those people who exchange the fund. So in the financial market, we have capital market, we have money market, we have forex market, etc. Insurance market, credit market, derivative market, debt market, they all are the types or the segments of financial market. So they all are the platform where both the parties who have surplus money and the party who have deficit of money, they both come to the financial market and they exchange the funds. They have. Now, how they are exchanging the funds? With the help of financial instrument, because it's not like that the deficit party will come with a empty suitcase and the surplus party will come with the suitcase of cash in which the lot of cash or money is available, and then they will exchange this in physical form. That's not how the transaction will complete it. So definitely the transaction will be completed on the basis of some instrument, because you required a proof. If you are giving your money to someone, you required a proof that you have given money to that particular person. And for that we have financial instrument, which covers shares, bonds, debentures. It can be commercial paper, it can be certificate of deposit, it can be your mutual fund, it can be your insurance, etc. It can be your Casa Rafa. Even Casa Rafa is also a financial instrument in which we are exchanging the funds. Okay, so financial instrument, all these are the financial instrument. And the market participant can be banks, it can be NBFCs, it can be primary dealers, it can be your individual, okay, etc. They all are the market participants. So any, like me and you also are the market participant. The government can become the market participant, NBFC can become the market participant, your primary dealers, your all the corporates, all the we can say institutions who requires the fund, everyone is a market participant. So they all, these market participant comes to the financial market, use the financial instrument and then exchange the fund with each other. Okay, so this is how the financial system works. So financial system is simply a system where we do exchange of funds among the people who have surplus money and the people who have deficit of money. And it will be done by using the component of financial system, that is financial market, component of financial instrument, and the market participants. Okay, so these are the component of financial system and the financial system. Now let's move forward. This was the basic introduction of financial system overview. That's your unit number 20. That's the Indian financial system and overview. Now the Indian financial system, we will be discussing evolution, structure, transformation of India's financial architecture in today's session. Okay, all of these we will be covering in today's session. So first of all, why financial system matters? Like what is the requirement of having a financial system and why it matters? The reason is the capital formation or drives economic growth. The entrepreneur needs funds to establish businesses, but the capital typically resides with the savers, individuals, firms, corporation, government who possess the wealth. So it happens always. Let's say, for example, if any one of you wants to start your own business, let's say, for example, like all of you or some people out of you wants to start their own business. And to start your own business, what you will do? Will you use your savings to start your business? Can we say that? Let's say, for example, I decided that I want to start my own business. And to start my own business, I'm using my savings to start the business. Is it a right decision? And the answer is obviously not. Okay, why? Because I cannot take a risk on my savings. I will always be ready to take a risk on someone else's money. That's how the financial system works. Every business will be running on someone else's money. Every entrepreneur is ready to take a risk on someone else's money. And this happens. That's very basic thing to see. And it happens. So that's what we're talking about here. Like capital formation drives your economic growth. If you have a capital, then you have an economic growth. Why? Because if people have capital, like if you have capital, you will demand the goods. The goods will be produced. When the goods will be produced, your GDP increases. When the GDP increases, your economic growth will increase. So capital formation actually drives the economic growth. But the entrepreneur who are actually performing the production of goods and services, they don't have money. The money is with the savers. Savers can be individual, it can be firm, it can be corporate, it can be government, anyone who have wealth. They are the savers. And they give money to the entrepreneur, and then entrepreneur take the risk to start a business. Okay, so financial system bridge this gap, channeling funds from surplus pockets to deficit pockets, enabling productive investment and economic development. Okay, and to make these savers funds available to the people who are helping us, the financial system is helping us, Hana, by providing us a mediator who will exchange the fund among these people. Clear? Next. Now we have two worlds of finance. Hana, we have what? We have a two worlds of finance. Now, what does this actually mean? The two worlds of finance. So it's very basic. Like if you remember when we used to be in school or college and we were unemployed at that time, and because the Diwali festival is coming, and at that time when Diwali festival used to come, we used to ask for a money, Hana, from our parents, from our siblings, from our grandparents, from our friends. So whenever we required the fund, we used to ask for money from any one of them, right? And at that time when we have taken funds from our parents or siblings or grandparents or friends, there was no rate of interest was there. They have not checked our credit history, they have not asked a collateral, they have not asked for a third party guarantee, and they have not given a time period that within this period of time you have to return your money. No such kind of conditions used to be there. Okay, so that was one of the world of finance. You are still getting the funds, but you don't have to pay interest, you don't have to return that money, no credit history is required, no third party guarantee is required, no collateral is required. So that used to be, it is still going on. That's the fun part of your finance, Hana? And that part of finance is called informal financial system. Okay, that part of finance is called as what? It is called as an informal financial system. Then the another one is, if you want to build your own house, if you want to reconstruct your house, you need a fund. If your child is going for the higher education and you need fund for that, then you have to go to the bank, Hana? Then you go to the bank, ask for a loan in which you have to have a good credit history, third party guarantee, collateral, everything should be there. You should have a regular source of funding as well, Hana? According to that, after checking everything, the bank will give you the loan or at a certain percentage and will ask you to return that loan in certain number of EMIs. Okay, and if you don't do that, bank will do what? Bank will take your collateral, will auction your collateral, and will recover their money. So that's also one of the part of your financial system, and that's the formal financial system. Okay, so these are the two worlds of finance. So informal financial system is what? Informal financial system means it evolved from social structure. Hana, it evolved from what? It's a social structure we have, that we are asking money from our relatives, friends, or anyone. So it will cover individual money lenders like traders, relatives, neighbors, informal association and funds, local brokers and front brokers, low transaction cost but unregulated will be there. Hana, they are unregulated. No rules, no regulation, no regulatory body will be there under the informal financial system. Okay, the parties who are involved, they will decide what they want to do or how they want to do it. But no regulation, no code of conduct, no regulatory body will be there. The transaction cost will be low but unregulated. Okay. Now in formal system, it is organized, it is institutional, and it is regulated backbone of the economy. So like financial institution, banks, NBFC, insurance companies, financial instrument like loans, deposits, securities, apart from that shares, bond, debenture, etc. Financial market like money, capital, forex, etc. Regulatory oversight and consumer protection will be there. Like if you go to banking sector, RBI as a regulatory body is there. If you go to investment market, capital market, derivative market, mutual fund, venture capital, in any kind of market if you go, there is a SEBI as a regulator. If you enter the insurance market, ADA is there. If you enter the pension market, PFRD is there. So they are the regulatory bodies. They regulate all these sectors. They give the terms and conditions. They give the rules, regulation, and restrictions to us. And according to those rules, regulation, restriction, according to their criteria, we have to follow that if we want to participate in the financial system. And that's a formal financial system. So two worlds of finance covers informal and formal. Informal, unregulated, and no code of conduct will be there, but formal is regulated with the code of conduct, with the regulatory body. Okay. Now, what are the components of formal financial system? I have just discussed that. The first, we have financial markets. Hana? The components of financial system are financial market. Money market, which is regulated by RBI, it is for short term. Short term means less than 1 year. Then capital market regulated by SEBI. It includes stock, bonds, debentures, etc. Forex market, again regulated by RBI. It's a currency exchange market. Then insurance market, that transfers the risk of financial loss to the insurance company, which is regulated by IRDA. Okay, these are the financial market. Then we have financial instrument like assets, liabilities, and other services are there. So in assets, loan, investment, placement, derivatives will be there. In liability, deposit of public insurance policy, mutual funds unit, pension contribution, they all are the liabilities. So it facilitates wealth transfer and risk management as well. Okay, so financial instrument include all kinds of instrument. It will include shares, bond, debentures, commercial paper, certificate of deposit, your mutual fund units, everything will be there. Apart from that, these deposit, these loans, insurance policy will also be the part of your financial instrument. Then financial institutions, these are the market participants that can be banking, non-banking, regulatory. Okay, these are the financial institution which are the participant or the component of a formal financial system. Informal financial system do not have any component because definitely they don't have any rules, regulation and oversight on them. So informal financial system do not have any component, but the formal one have, which covers financial market, financial instrument and financial institution, or you can call it market participants. Okay, now in 4 phases, we have seen the development of financial industry of our country. Okay, in how many phases? In 4 phases, the development of financial market happened. Like first, 1770, Bank of Hindustan. This was the first Bank of India, India's first commercial bank. It was discontinued in 1832. It established in Calcutta in 1770, and this is the bank which started formal financial system in India. Hana, if any bank which started formal financial system in India, it was Bank of Calcutta, which established in 1770. Okay, then 1806 we had first presidency bank, Bank of Calcutta, which was later renamed as the Bank of Bengal in 1809. It is the precursor to State Bank of India. Apart from Bank of Bengal, we have 2 other presidency banks. So 1806, we had Bank of Bengal, which used to be the Calcutta, but its name have been changed as a Bank of Bengal. Then 1840, we got Bank of Bombay. And 1843, we got Bank of Madras. So Bank of Bengal, Bank of Bombay, Bank of Madras, these used to be 3 presidency banks of ours. All these 3 presidency banks are the precursor to the SBI, because all these presidency banks have been amalgamated and they created Imperial Bank of India in 1921. And then Imperial Bank of India changed into SBI in 1955. So this is how the presidency banks becomes precursor to the SBI. Okay. Now 1875, the Bombay Stock Exchange established. That was the Asia's first stock exchange, catalyzing capital market development. Then 1935, RBI's establishment was done on the recommendation of Hilton Young Commission. This commission also named as a Royal Commission on Indian Currency and Finance. Okay, so Hilton Young Commission first time recommended to establish RBI in 1926. In 1926, it said that we should have a central bank which will regulate the activities of a banking system in India. And for that, The Hiltonian Commission, which is also called as the Royal Commission on Indian Currency and Finance, they have recommended to establish RBI first time in 1926. Then 1934 RBI Act came and 1st April 1935 RBI establishment was done. Okay. Then 1939 foreign exchange regulation begins with defense of India rules during World War II. Okay. So 1939 was the first time when we started regulating the foreign exchange. Foreign exchange means foreign currencies. Okay, we started regulating foreign exchange from the year 1939. And after that, 1947, Hana, after 1939, in 1947, we got Foreign Exchange Management Act, which was replaced in 1973 with the more comprehensive Regulation Act. It is our Foreign Exchange Regulation Act have replaced the Defense of India rules, in 1947. Then 1973, more comprehensive Foreign Exchange Regulation Act came. And then in 1999, this have been replaced by Foreign Exchange Management Act. Okay, so this is how the foreign exchange regulation is started in India, and now FAMA, Foreign Exchange Management Act, is regulating our foreign exchange transaction. Okay, and at the same time, we have seen the turbulent phase saw approximately 600 banks operating with many small institutions, they failing to gain public confidence. A lot of banks have failed at that time, and that actually people actually lost confidence on the banking system. They stopped trusting on the banking system of our country because a lot of banks actually failed. Clear? So this happened in phase 1. Now the phase 2, phase 1 was pre-independence. Also remember the names. The phase 1 was the pre-independence era, or we can say prior to 1947, what happened that we have discussed. Now, after phase 1, we have phase 2, and the phase 2 talks about post-independence. Phase 2 is all about what? Post-independence. Post-independence means after 1947. So from 1947 to 1991, we had second phase of development, and that was the post-independence period. Okay. So here the socialist banking era was there. Like economic growth with social justice became constitutional mandate, and the government pursued planned development through a mixed economy model. Okay, so India became what? It have the mixed economy model where the government and private sector both are working together. Okay, so in 1948, RBI Nationalization Act have been introduced. Because when RBI was established on 1st April 1935, RBI required initial capital of 5 crores, which was not available with government. So RBI shares have been issued, and those shares have been purchased by individual people like us. And that's how RBI became private shareholders bank. But then in 1948, RBI Nationalization Act was introduced. RBI Public Ownership Transfer Nationalization Act have been introduced in 1948. Then on 1st January, RBI nationalization happened when? It happened on 1st January 1949. And in 1948, actually the act was introduced. Okay, and the nationalization happened 1st January 1949. So from this date, RBI became government's bank. What is nationalization? Nationalization is simply a process where the government purchased 51% shares or more than 51% shares of a private entity to have its ownership. And in case of RBI, on 1st January 1949, Government of India have purchased 100% shares. So RBI became the government bank from 1st January 1949. Okay, then 1955, State Bank of India came, where Imperial Bank of India converted to the SBI, and this Imperial Bank of India was established in 1921. How it was made? By the amalgamation of 3 presidency banks. So Presidency Bank of Bengal, Presidency Bank of Bombay, Presidency Bank of Madras. These 3 banks was amalgamated, and their name changed to Imperial Bank of India in 1921. Then this Imperial Bank of India's name changed to SBI in 1955, and that's how the first, or I can say the largest public sector bank of our country came. That is SBI. Apart from Imperial Bank, Presidency Bank, a lot of banks have been merged with SBI. And that's one of the reasons that SBI became largest public sector bank. Because all the banks merged with SBI, their branches, their customer, their capital, all come together to the SBI. And that's why SBI became the largest public sector bank. Clear? Now, 1969 bank nationalization was done. That's the first nationalization, or we can say wave one. So the first nationalization of commercial banks was done in 1969, in which 14 large commercial banks or 14 major commercial banks were nationalized. These were those banks which have deposit over 50 crores, 50 crores or more than that deposit. Those banks have been nationalized. So what happened after introducing even RBI? It has been seen that at the ground level, a lot of rules and regulations are not followed. Still, the objective of banking sector was not fulfilled by the banks after having RBI regulation and everything. So then Government of India have decided to make sure at the ground level, we are providing benefits to the customers of ours. We are collecting funds from them in form of deposit and etc. They have decided to nationalize the bank. Nationalize means same process. Purchasing 51% shares or more than that shares from a bank to get their ownership. So government have purchased 51 and more than 51% shares of a private bank, and such number of banks was 14. So 14 banks nationalization have been done in 1969. And the criteria of these 14 banks were very simple, that they should have 50 crore or more than that public deposit. And such kind of only 14 banks were there in India. That's why only 14 banks nationalization have been done. Okay, now the second nationalization happened in 1980, in which 6 major commercial banks were nationalized. And 6 more major commercial banks were nationalized in 1980. Okay, it was the wave 2 or the second nationalization. And the criteria was the bank should have 200 crore or more than that public deposit. And such number of banks were only 6. So this is how in 1969 the first nationalization, and in 1980 the second nationalization have been done. Okay. Acha, how many nationalized banks we have right now in India? How many nationalized banks do we have in India? Let me know. 12 nationalized banks are there. Okay, what about others? Okay, very good. It's not 12, it's 11. Hana? Only 11 nationalized banks are there in India right now. All the others have been merged. Okay, 12 is the number of public sector banks. We have 12 public sector banks, but only 11 nationalized banks are there. Okay, because the merger happened. How it happened, I will explain later. Now, 1975 RRBs was established. So we have seen a lot of commercial banks were there in India. But still, if we talk about the study of Khan committee, it says that only 33% people have joined the bank. It means only 33% population had the bank account in 2004. Then after that, after having RRBs also it happened. And a lot of people were not capable of linking with the bank because they were not able to understand how this works. And also the commercial banks had the target to add more and more people with them, like doing financial inclusion, adding more and more people with the financial product and services at an affordable cost. But commercial banks were not fully focused on the rural economy. And the need of rural economy was high at that time. So that's why to uplift the rural economy, we have introduced the concept of regional rural banks. Okay. So in 1975, the RRB was established, and it was established to promote financial inclusion in rural areas. It's not like the commercial banks were not working at that time. They were working, but we needed a bank which will uplift the rural economy and will work dedicatedly for the rural economy. That's why RRB was introduced. And RRB, the first RRB was Prathama Gramin Bank. It was established on 2nd October 1975. One exceptional case is there with RRB. The RRB Act came in 1976 when the first RRB was established in 1975. Okay. Now, next we have the 1991 crisis. I guess everyone is aware about this crisis. 1991 crisis we have. So the 1991 crisis, it is catalyst for liberalization. And because of this, we can say we have introduced the LPG policy. Everybody is aware about the LPG policy now. So when we talk about liberalization, privatization, and globalization, that's the policy or that's the economic reform we had. And that was the last reform. That was what? That was the last reform in industrial policy we had. That was the LPG policy. So what happened and why we have introduced the LPG policy? A lot of reasons are there. In India, the inflation was rising. The prices of goods and services was keep rising. At the time we have introduced the LPG, before that inflation was very high. It was in its galloping stage. That is around 16% inflation was there. Second problem was fiscal deficit. The government of our country have taken a loan from a lot of institutions and we were not capable of returning that loan amount. And what happened if you do not return the loan? Definitely you will be named as a bankrupt. And in that situation you won't be able to take a loan again, and the same can be done by the with the country. And this was the situation of India. It was the situation of India that at that time fiscal deficit was very high. Fiscal deficit means the government have taken loan from a lot of institution, but what not capable of returning it back. Okay, that was one of the issue we had with the 1991 issue. Clear? Then next thing, the third, two reasons we have discussed. The third reason was that the balance of payment crisis happened. Now, balance of payment crisis means when India was doing trade with the other countries, we were not able to earn much money, but we were be spending more money. So outflow from India to abroad or outflow from India to rest of the world was high in comparison to inflow. So our expenditure was very high. We were importing a lot of goods, but exports were very less. And that's why the balance of payment crisis came. And because of that, we have faced one or more loss. And after that, we have seen the foreign currency reserves were also declining. Foreign currency reserve means the reserves of foreign currency in India with RBI. It was keep declining because at that time, the Gulf War happened. At that time of economic development or at that time of economic transaction, India was totally dependent on the imports of crude oil. Right? All the demands of crude oil used to be fulfilled by its imports. And India used to pay a lot of foreign currency to import the crude oil. And at that time, Gulf War happened. Gulf War happened means the war happened in the Gulf countries. And because of that, the prices of crude oil, it increased more than double. It used to be $15 per barrel, but it became $33 per barrel. And for that, we have to pay huge amount of money to import the crude oil. And that's how the foreign currency reserve declined. And we were only capable of making the payment of our imports for the next 2 and 3 weeks. Apart from that, if we continue to import any goods or services from the foreign country, we will not be capable of making the payment of its trade. Okay, that was one of the issue. And the next issue was there that after happening all of these things, the World Bank and IMF came into existence because India went to them and asked for a help, where the World Bank and IMF have given a compulsion. Like if you introduce reforms in your economic policies, then we will help you out. So the compulsion of World Bank and IMF was there. And because of that, we have introduced the LPG policy. So out of all of these, some reasons are written here, like triple vampy that changed everything. Slow growth was there. Hana? Second, export collapse. Third, Gulf War shock. So do remember, inflation was rising, fiscal deficit was rising, balance of payment prices were there, foreign exchange reserves were declining. Apart from that, we have also seen that at that time, 1990s was the duration when the World Bank and IMF have helped us. They have given us the loan, but we know that IMF loan comes with the stiff conditions. And that condition was India have to liberalize their economic policy. And then we have introduced the liberalization, privatization, and globalization. LPG policy was key. Okay, so a lot of reasons are there because of which the LPG policy have to be introduced. So India actually pledged 67 tons of physical gold for $3.9 billion IMF emergency loan, and the condition was to liberalize the economy. Okay, the condition was what? The condition that you have to liberalize your economy, and the condition was you have to give the collateral. So the collateral was given, it was the gold, and at the same time we are saying that the IMF have given us the loan, but with the stiff condition. And the condition was what? Very simple, that you have to liberalize your economy. Liberalize your economy means do remove the rules, regulation, or restrictions. Hana, liberalize means what? Remove the restrictions, remove the rules, regulation, restrictions. That was the one of the, we can say, restriction of IMF. Like we are only going to give you the loan if you will change your rules, regulation, you will ease your policies, then we will provide you the loan. Okay, now clear? Let me know. +11, yes, correct. 11 we have a nationalized bank and one is a public sector bank, that one is a SBI. So SBI plus 11 banks, 11 nationalized banks makes the public sector banks. Okay, now scheme. In the third phase, the Narsimham reform. Okay, the Narsimham reform was introduced. And if we talk about the Narsimham committee is very important. Narsimham committee 1 and 2 is very important for us because a lot of questions from there you can find. That we will be discussing in the next chapter in detail. So you can see the restrictions or the reforms have been given here, in which it have been said that we have to lower the CRR and SLR. Now CRR and SLR are the reserve ratios. They are the part of monetary policy and they are the reserve ratios. And at that time, the Narsimham reform have said that we should lower the CRR and SLR. Now, when RBI reduces the rates of CRR and SLR, it means the banks have to maintain reserves lower. And if banks are maintaining lower reserves, they will have more money to provide the loan. And if the bank will provide loan, people will have money, people will demand goods and services. The demand will increase, then the production increases, the GDP increase, the economic growth increase, everything will be good. That was the target, to reduce CRR and SLR. And right now also, if any time RBI feel like that we need to increase the money supply in the market, RBI still reduces the CRR, SLR. Right? So first recommendation was to lower SLR and CRR. Acha, what is the current CRR and SLR? What's the current CRR and SLR? Let me know. So we have to study update till June 2025. And I do remember that. For November 2025 paper, we have to cover update till June 2025. For all the subject of yours, updates will be covered till June 2025. So CRR is 4%. And what about SLR? What is the current SLR right now? So CRR is a cash reserve ratio in which all the scheduled commercial banks have to maintain a reserve with RBI in form of cash, and it will be a percentage of NDTL which will be prescribed by RBI. And SLR is a statutory liquidity ratio which have to be maintained by all the scheduled commercial bank with themselves only in form of cash, gold and government security as a percentage of NDTL which is prescribed by RBI. Okay, that's the SLR. Now SLR is 18%. Okay, now prudential norms. Prudential norms have been given like related to asset classification, provisioning for bad debts, income disclosure standard, ensuring transparent bank financials, etc. So prudential norms means after studying the situation, we have given such norms which help us to minimize the risk. That's the prudential norms. Then the next recommendation was capital adequacy ratio should be maintained 8%. So minimum capital to risk weighted asset ratio strengthened loss absorption capacity by March 1996. And at that time, it had been said that the CAR should be 8%. Okay, so it is also named as a capital adequacy ratio, or you can call it a capital to risk weighted asset ratio. This was introduced under the Basel norms. So Basel norms was introduced, they were the international banking regulation. It was introduced to reduce the credit risk, operational risk, and market risk in the banking business. And in them, Basel 1 norms or Basel Accord 1 have introduced the capital adequacy ratio, in which it have been said that all the banks have to maintain a certain percentage of their risk-weighted assets, which will help them to cover up or to come up out of the loss of NPA in the future. Okay, so that's why capital adequacy was introduced. And in the Narasimhan Committee 1, the target was to achieve 8% CR by the banks. Okay, now interest rate deregulation have been done. Market forces allowed to determine deposits and lending rate phased from 1992. So earlier, all the rates used to be decided by the regulatory body. That was RBI, still RBI. So RBI used to decide the rates on everything. But now in 1990s, it have been said that interest rate should not be regulated. Like it should be on the bank, how much they are able to provide interest to their customer on deposit account, how much they required as an interest over a loan. So that should be decided by the banks only. So then the interest rate deregulation was introduced, in which it has been said that the interest rate will now focus on the market forces. Market forces means demand and supply. On the basis of the demand and supply of deposits and loan, the interest rate will be decided on the deposits as well as on the loan. And it started from 1992. Okay. Now, it also recommended that we should enter new private banks. We should give license to the private banks. We should also allow the foreign companies to invest in banking sector. That is also allowed. So this was introduced simply that private sector should invest in the banking sector and the other sectors, as well as the private foreign investment should be done there. So if we talk about private sector banks, if I talk about payment banks, if I talk about small finance banks, they all have 74% FDI allowed. How much FDI is allowed? FDI limit is 74% for all the three. Okay. Now, when it comes to public sector bank, for public sector banks, the FDI is only 20%. How much? Only 20%. But it have been allowed. Now, debt recovery tribunals, it says that 1993 Act had established 6 specialized tribunals which will accelerate the NPA recovery process. So NPA is what? Non-performing asset. Like assets of a bank is loan and advances. Asset of a bank is loan and advances. Why a bank is providing loan or advances? Simply to earn interest. To earn income, bank is providing loan and advances. But on that income, on that loan, bank stopped generating income because customer stopped repaying the loan amounts, and that created the loss for us. That's the NPA. NPA means non-performing asset, the asset of a bank which stopped generating the income for a bank. That's called as a debt recovery tribunal. Okay, so a lot of recovery tribunals was introduced for the NPA recovery process. Like we have DRT, DRAT, NCLT, NCALT. SARFAESI is there, IBC is also there. They all are the debt recovery tribunals. Okay, now capital market modernization have been done, like National Stock Exchange was introduced in 1992, and the National Stock Exchange started automated screen-based electronic trading system. In India, automated screen-based electronic trading system was introduced, and that's all about NSE, National Stock Exchange. So NSE started automated screen-based electronic trading system. Okay, before that, Bombay Stock Exchange was working in India, but it was doing the physical trading. Screen-based trading system introduced by NSE in 1992. Okay, now NSDL and CDSL was introduced, and they actually enable the 99% dematerialization. It means what the NSDL and CDSL do? They are the depository system. National Securities Depository Limited, Central Depository Services Limited. NSDL established by NSE, CDSL was established by BSE, and they both have the same task: to convert physical security into electronic form and submit it in the investor's demat account. They both do the same work: convert physical security into electronic form. Okay, so they have done 99% dematerialization. Settlement cycle from 14 days, it became T+2, and then now it became T+1. It means trade day plus 1 day. From 2022 January, the trade day or settlement cycle actually became T+1. T+1 means trade day plus 1 day. So if you are doing trading today, next day within 24 hours your settlement will be done. Okay. Now foreign institution investors permitted 1992 under portfolio investment scheme. So foreign institutional investors have been allowed that they can participate. They can participate in what? They can participate in the portfolio investment scheme, and it was allowed in which year? It was allowed in 1992. Okay, next. Now modern transformation. What modern transformation happened? So digital payment revolution introduced, like UPI was launched, NEFT, RTGS became 24/7. So NEFT became 24/7 in 2019. RTGS became 24/7 in 2020. They are making India global payment leaders. Then financial inclusion drive, Pradhan Mantri Jan Dhan Yojana came, JAM Trinity came, payment bank, small finance bank came. They all had the same purpose, to do financial inclusion. Then bank consolidation, public sector banks reduced from 27 to 12 now. How many public sector banks we have? Only 12. Okay, so EASE agenda was also introduced. What is EASE? Enhanced Access Service Excellence. Sorry. It is Enhanced Access Service Excellence. It was EASE reform was introduced to make sure that public sector bank will have a profit maximization. Public sector banks will be having better asset quality. They will be earning more profit, like profit maximization, asset quality, and digital capabilities. These three we want to expand for public sector bank, and that's why the EASE reform was introduced. Okay, then IBC, Insolvency and Bankruptcy Code, asset resolution was introduced. Then IBC came, and NARCL Bad Bank also came, which addressed 2 lakh crore stressed asset. So the NARCL will take over 2 lakh crore. NARCL will do what? NARCL will take over 2 lakh crore NPA of a banks and then recover it. Okay, now FDI cap in insurance, it started from the year 2000. In 2000, it was first allowed, that was 26%. Then in 2015, it changed to 49%. Then in 2021-22, it was changed to 74%. And then in 2025-26 budget, it changed to 100%. So what we have to remember? We have to remember this one. Why? Because till June 2025 updates we have to cover. And in March 2025, FDI limit for insurance companies have been increased from 74 to 100%. Okay, even might be they can ask filling the blank question also on this, and they can ask in different years what was the FDI and insurance. So that's why I have written every year 2000, 2015, 21, 22, and 25, 26. And I do remember that. Now, DICGC, we all know, Deposit Insurance and Credit Guarantee Corporation, which provide insurance on the public deposit to the banks. It used to be 1 lakh per customer, but this have been increased from 1 lakh to 5 lakh. This is provided by whom? By DICGC, Deposit Insurance and Credit Guarantee Corporation, which is a subsidiary of RBI. Okay. Then we have 12 public sector bank. In 12 public sector bank, we have 1 SBI plus 11 nationalized banks. This is how 12 public sector bank became. Okay, and if we talk about India's financial system, it continues evolving through technology adoption, regulatory refinement, infrastructure development, positioning itself as a resilient, inclusive, globally competitive framework driving the economic growth of the country. So this is how the India's financial system is keep evolving. Okay, by using the technology, like now the fintech, techfin also came, neobanks also came. So they all are the part of financial system adopting the technology. Okay, now we will be ending here today only. Let me know, do you have any doubt in today's session? Whatever we have discussed here, does any one of you have doubt in that? Now, those bankers who are watching us on YouTube, I would love to inform you all that from tomorrow onwards, you won't get these classes on YouTube. This is the last demo which is available on YouTube for all of you. From tomorrow onward, these classes will only be conducted in our paid batches. Okay. Now, if you want to enroll, if you like the classes and if you want to enroll in the paid classes, simply download CAIIB 24/7 application. Select the exam category JAIIB, CAIIB. Go to the JAIIB November 2025 and you will find here the crash course. So this is an English medium crash course. Click on the crash course. Do check the offering, live class, mock test, ebooks. When you scroll down, you will find the study plan as well here. All the 4 subject study plan is given here. After checking every detail, just click on the buy now option. Enter a code here that will be Y496 and apply. So once you apply, you find here 79% discount, but it will become 80% discount once you enroll from the other 24/7 application. Hana? So you have to do what? You have to enroll from the other 24/7 application. You can use the code Y496. You will get 80% discount and 6 months validity on this. Okay, so enroll accordingly. And if you have any doubt in this session, you can ask in the comment section. And also do revise it if you're watching it recorded. You can revise it from our 24/7 recorded videos available in your account, and then you can ask your doubt in the next class. Okay, so let's end the session here. We'll see you all in the next session. Thank you all for joining this class with me. We'll see you all tomorrow at the same time, 7 to 8 p.m. Okay, thank you everyone. Take care.